Just taking a look then at equities, and the reoccurring conversation, I guess, the last 2 mornings has been what direction do you think equities are going to finish today, and pretty even 50-50 split between those thinking will finish higher, those thinking will finish lower. And obviously yesterday, after we kind of continued to push higher initially until we got shortly after the open on Wall Street, the markets just came under some really heavy selling pressure. The Nasdaq was a big underperformer. A lot of people speculating that the tech sector could be one of the more hardest hit, given its reliance on foreign workers, its relationship with foreign trade partners, and so on and so forth. And so that led to a quite aggressive move to the downside in the SPOOs, but it was, as I say, very much Nasdaq led. But then, given the indecision that I think very much summarizes the current market conditions, we just rallied, not quite as a quicker pace, but still pretty aggressively, all the way through the European close to the exact point of where we were trading pretty much, and actually managed to eke out a positive session on what you could have been fooled was going to be the moment of profit taking and people's realization setting in. That's kind of how it felt at the open of Wall Street when we were selling off, but then lo and behold, it was almost a better level just to get long again at that point. But I'd say the equity sentiment is quite difficult at this point. We're going to talk about a couple of bank research reports that I've been sent this morning and look at their views, and I think that as I've been kind of suggesting, there's a difference between an intraday view and a slightly longer term on how this might play out, which I think overall is still more negative than it is positive to some respects. Let's just take a quick look then at a few charts that I've seen this morning. Obviously, the winners and losers list since the change in the administration in the US, Mexico obviously the hardest hit. If you've read your Jim Reed note this morning, quite hilarious the fact that the timing that Mexico are playing USA as a World Cup qualifier this evening. You just can't make these things up, really, can you? I'm scarce to think what kind of reception the crowd are going to give when that football game kicks off later on today, but that will be quite interesting. Latin America, obviously the EMs have been hardest hit. This kind of fear then about renegotiation of trade pacts and so on being more negative for those countries given Trump's protectionist kind of view. And then scaling all the way down to Russia, where if you remember on the morning after the results were kind of known, Putin was the first international kind of major name to congratulate Trump. Certainly the previous administration of sanctioning during the result of the Ukraine crisis a few years ago from Obama's reign, it's the complete opposite in terms of the relationships that Trump will be looking to instill with Russia. So Russia's actually outperformed on that more leniency type view from the Western world. Some other charts that have been quite interesting, and what you had yesterday was a bit of divergence even within the 3 major US indices. I'd say the S&P was kind of the more middle ground, but you had the Dow finished again last night, record highs, albeit it was a marginally positive session, but the Nasdaq underperformed sharply for those reasons I just said. Now for the financials, they've actually rallied very aggressively. You can see here, the industry is up, the financials, 11% this week. And obviously a predominant part of that coming in the second half of the week post-election. So banks and healthcare shares surging as the Trump administration will roll back regulatory scrutiny of these industries. In particular, a lot has been made yesterday afternoon and this morning about the rolling back of the Dodd-Frank rule, which would obviously be more positive for banks' performances if they were to be able to be less impeded, I'd say, by stringent regulations, which has kind of shackled their hands to a certain degree in the fallout of the financial crisis. So a relaxation of those rules would be seen as a net positive for these bank stocks. In addition to the fact that also, if inflation starts rising and US interest rates start going up, obviously that also helps with the margin aspect as well, which these banks have struggled on in this zero interest rate environment that's been in place for several years. So banks definitely seeing the best of it comparative to the techs, which got hit very hard yesterday. Fed impact. So looking at, I guess, probabilities, Fed futures implied yield. Yields has been the real focal point, I guess, of some of the market moves. Equities actually, as has been the case really, and when we were trying to trade and navigate in the last few months a hawkish Fed, stocks have been a harder play, I'd say, and fixed income has been a little bit more clearer with the price movement. And certainly this idea of, dare I say it, Trumpflation or Trump tantrum, as it's being coined by Deutsche Bank this morning, the fear of fiscal spending giving the economy an artificial boost, so stoking aggregate demand will heighten prices in the near term. As such, then inflation expectations are increasing, and this is playing out with the yield rising, and then all the more reason for the Fed as well to cement their December hike. And so after the initial flight to quality bid that was seen when we kind of the scales tipped in favor of Trump, when those swing states were coming out, and particularly Florida, we hit that high at 31, and ever since then full reversal, and then we've kind of more than 3 times the size of the move now in treasuries. And I think treasuries, in terms of a trend, I would say that we've still got some way to go to price in this kind of new inflation threat that's going to materialize as a byproduct of the policy measures in which Trump wants to put into place. Also as well, if inflation starts to shoot up more aggressively than many had feared, then obviously this also brings about questions then, not so much about the hike in December from the Fed. Most banks think that will still happen, but the trajectory of interest rate hikes thereafter is really critical. But the Fed's hand may well be forced by the fact that they need to be fairly moderate rather than more dovish in terms of that rate path in order to contain this pending inflation aspect. 2 things actually with the Fed. Don't forget, there's 2 vacant seats in 2017 that need to be filled. And given the fact that the Republicans have full control on Capitol Hill, even despite Janet Yellen's term not ending till 2018, they could look to shake up the composition of the FOMC makeup in order to make it more hawkish, if you like, even though Yellen is still there. Now, they can't fire Yellen. Yellen can resign. So she's either going to resign or she's there till the end of her term in 2018. The latter is much more, I would say, what's likely to happen. So they can actually force their hand a little bit in terms of the US government. A quick look then on that yield perspective. There was it's not only playing out in the US. If you look at this morning, German bund yields are now at a 9-month high. Italian 10 years head for 2%. This is also following in suit, if you remember, with a very sharp spike that we've seen in UK yields that has seen gilts plummet more recently on the back of this fear of heightened inflation post-Brexit, as the sharp depreciation of the pound elevates prices to some consumable goods well in excess of 10%. And we're starting to price in future inflation in this country, which, if you're according to NISA, for example, one of the main influential UK think tanks, they foresee it going up to as much as 4%, if not higher. A quick look at, I'll try and get this out to you probably when we do the strategy, but essentially HSBC have done a nice FAQ on the 10 most popular questions that they've had in terms of what a Trump win means for various different asset classes. I'm not going to go over all of them, but there's a couple here to look at. Obviously, how will the dollar be affected by the Trump victory? Well, the clean sweep Republicans is a major event, and this obviously has the most powerful impact against the emerging market currencies. Medium-term implications for the dollar of Trump's proposals are mixed, but on balance still negative, as fiscal expansion and new legislation to encourage repatriation of overseas profits would likely be positive for the dollar. However, a weaker dollar may be part of Trump's efforts to spur manufacturing. A tough migration policy could curtail potential growth. Because that's the other thing not to forget, is that if Trump does fulfill one of his main pledges, then there's roughly 11 million illegal immigrants in the US. If you were to remove all 11 million, that is going to have a very definite and real impact on the performance of the US economy, because these are all people who will be in work. Other areas which are also interesting, are equities being too complacent? I think that's a question of which certainly I've had over the last few days, whereby people are a little bit surprised that we're not selling off in equities, is usually the way that most people's biases are kind of lent toward. What HSBC are saying is, we do not see this benign reaction lasting, and Donald Trump's victory is likely to lead to a prolonged period of policy uncertainty, which is already at unprecedented levels globally. This uncertainty comes against a backdrop of elevated valuation multiples, optimistic earnings growth expectations, and investor sentiment that is far from being bearish. So tax cuts and increased infrastructure spending could lift US earnings growth in the short term, but there is a risk of more aggressive Fed tightening cycle which could weigh on valuation multiples. Don't forget, these corporations have been almost pumped up by the fact of having such a low interest rate environment for such a long time. But if you're going to do massive large-scale infrastructure projects, that's going to be profitable for these companies in the short term. But the end result, when the dominoes fall, is that inflation goes up, the Fed have to hike rates more aggressively, and actually it gets to a point where that starts to become troublesome for these companies whose valuations, some would say, were already overstretched. And then this removal of accommodation is much quicker in order to counter that inflationary threat, and that could be a concern for equity markets slightly longer term. So again, it's kind of a play on I guess what's happening right now, and then what might happen a few months to 12 months down the line. The final question I'll look at here is gold, because obviously that's a highly sensitive product to risk and uncertainty, and Trump's election win is likely to generate sufficient investor uncertainty to propel gold prices beyond the recent highs of $13.75 reached over the summer, but nowhere near the record 1920 during the financial crisis. I agree, there's no way we're going to get up to those types of elevated levels, but certainly HSBC erring on the side that we've got room to the upside. Much of the rationale rests on Trump's trade and protectionist proposals, and gold tends to appreciate during periods of protectionist and populist policies. Let's not forget as well that if I show you this chart, we were talking about this yesterday, there is a hell of a lot of European political risk coming up in the coming year. This is kind of the main highlights for you from the French presidential elections, the same in the Dutch and German federal elections, as well as the Italian constitutional referendum. Had a read about this document and some of the outcomes, but certainly the populist movement becoming the new political norm on a global level has certainly heightened the risk around events such as, let's say, the French presidential election, which, according to the polling, still Le Pen is not looking as the favourite, but certainly I think you can't underestimate that kind of more right-leaning view at this point in time, given what events have occurred in the summer and this week. Quick look at what Deutsche Bank is saying. Their overall view, I did share this with you this morning in the chat room. You can, if you just scroll back, you can click on the graphic. But in terms of the Fed, they say that the Fed signalled intent to raise rates and data. Financial conditions remain supportive. Inflation could allow for even more hikes. So as per the conversation we just had, so the Deutsche is still expecting a deck hike. Now, I've read pieces from HSBC, Credit Suisse, and Texas. They're all still going for the same view of a deck hike still being priced in, if not even to a greater extent now, given this inflationary aspect. So they're looking for continued curve steepening. The dollar supporting strong dollar theme, I guess, for the time being. The steeper yield curve from long end sell-off is negative versus safe haven currencies, but positive versus EMs. Views of a new Treasury Secretary about dollar strength will be important, so who he announces for that as part of his makeup of team will be something to look out for. Okay, quick look back at the charts. There is one currency which has dumbfounded quite a few people, and that has been, I guess, a divergence materialised between the euro-dollar pair and cable. Even this morning, much like what we've seen in the last 48 hours, you've got generally lower euro-dollar and then sterling outperforming. Now, first of all, there's a couple of ways to look at this and a few points I want to cover. One is, if you're looking at different central bank policies, we've now gone into this new mode of reflation is going to cause, potentially through fiscal stimulus, the Fed having to be more aggressive with their interest rate cycle after the hike post-December. That means that, as you can see evident playing out with the US 10-year, we've had a powerful move to the downside, and I foresee that still continuing for the time being, given I don't think we're still yet priced for that situation. So you've got a dollar which in the short term is still going higher. And then at the same time, as I just showed you with that table of political risk upcoming in Europe, there's a lot of nervousness about how this might play out over the next 12 months from a political aspect in the Eurozone. Now, coupled that with the fact that the ECB's bond buying program is soon coming to an end in March 2017, December for the ECB is actually an important meeting, because they'll probably need to give a signal about tweakage or extensions beyond that period. And it's looking more inevitable that that could well be the case. So you've got a dollar which inherently fundamentally is moving higher, a euro that's weakening, and hence you've got a bit more of a downside bias direction in the euro-dollar pair. Now with cable, obviously last week we had that big news about the UK High Court ruling, the fact that parliamentary members can now get involved about the triggering of Article 50, and therefore the deal going forward certainly softens the angle of which has been very aggressive from Theresa May and the Tory government. That's the sterling positive. Then you've also had this also quite prevalent inflation fear in the UK, which has prompted Mark Carney to talk about there's a limited tolerance towards prices going up to a certain level. So certainly they've moved more hawkish after a very accommodative mode that they were in August. So there's those sterling positives as well. But the other thing that I know that some of you guys were talking about yesterday, and I think carries a lot of weight as well, why sterling is outperforming, is about, could Europe's view of Britain change after Trump? And I think there's some very interesting points here that get covered by the FT, and I'll share the link into the chat room. But first is, Brexit is no longer looking like the isolated populist outburst that it once seemed. The consensus in Europe was to see the British as a perfidious Albion and wreckers of the European project. But following Mr. Trump's victory, Brexit looks more like part of a wider phenomenon across the West, in which the dispossessed are rising up against the complacent elites. European leaders suddenly under far more pressure to acknowledge this and recognise deep-seated concerns of their own citizens about migration and identity. Secondly, Trump's victory may give Britain much more leverage with the EU over a future trade deal. Until now, British have appeared ready to risk reduced access to Europe's single market without any uncertainty over how they can sign new trade deals with non-EU states. But Trump has signalled that he's prepared to sign a US-UK trade pact quickly. So if you think about it, this kind of lessens the, obviously the US is a very important trade partner that we'd need to renegotiate with, but if we can have that, as Trump has intonated, in place immediately, that gives you a much stronger bargaining hand than to have with Europe. So Europe almost has to concede to a certain degree to some of your terms. And then thirdly, the EU now has to think much harder about the security of the continent against a resurgent Russia. Mr. Trump's ambivalence over NATO raises doubts about whether the US would resist Russian aggression against the Baltic states. This means that in the Brexit talks, Britain's security card is now stronger. Let's not forget that Britain has Europe's biggest defence budget and is one of the few states ready to commit to combat. So if the US is getting ever more chummy with Vladimir Putin and Russia, then certainly, again, this gives the UK a very hard or strong hand in this negotiating table, because the fact that Europe needs us to be part of that in terms of the Russian threat, as was materialising back in the Russian-Ukraine crisis. So there's quite a few things ongoing here where I feel, let me pop this into the chat room so you can read yourselves, but these would all be sterling positives. This is coming in the macro backdrop, I would say, of a repricing of the expectation of forthcoming inflation, a more hawkish turn that we've seen from a less accommodative Bank of England. And so I think that's why you're getting this outperformance that we've seen materialise in sterling currency over the course of the last 48 hours in particular. I mean, looking at it here, this was the actual night of Brexit. This was the night of Trump. And that was when we had the initial kind of dollar getting hit, people panicking. Then we had the reversal by the time the morning came. And now we're getting another decent push to the upside. You can see here we kind of found a bit of a floor around the previous Trump or election high. And now we've just continued to power on to the upside. Just looking here, we've talked about this before technically in terms of cable as well, that if you think about it from the range it was locked in predominantly from, well, it was really defined by you had that algo flash crash. We're now literally at the algo flash crash opening bar on that night. That comes in at 26.30 on a daily continuation. Above here, obviously, there's open air until the key level, which was that support post-Brexit. If you remember, a few days after, that was at 128.06, and it was that Tory conference that was held that triggered the break of that then saw a very aggressive move to the downside. So a couple of things to be aware of here in sterling. We're literally at the point of full reversal of that algo spike, and then above here, again, technically, there's still some open air up at least to 27.50, 28.06 will be a big level though on the upside. Okay, finally, quick look then just to wrap things up for the schedule for today. On the calendar, as has been the case the last 2 days, I would not be looking to the calendar to drive these asset prices. I certainly would be just playing the market by how it's still viewing this Trump situation. So continue to just keep an ear on the squawk and an eye on the headlines as well. The only real interesting things you've got is the OPEC monthly oil report. Of course, we did see the IEA's oil monthly report yesterday at 9 o'clock, and just further reasons here for greater oversupply in the market, with OPEC now producing at record levels. So this deal looking ever more fragile in terms of the Algiers deal heading into the OPEC meeting at the end of this month. Looking back at the calendar, then you've got Michigan, University of Michigan consumer sentiment. This is the preliminary reading. Looking at this, the last time out, we printed down at 87.2. It was the lowest reading since September of 2015. Don't forget, this was heading, of course, into the election. Be interesting to see how it comes out now forward looking, but I wouldn't imagine Michigan is going to have a great impact on prices at this point in time. Certainly from a Fed perspective, the market is still expecting that hike, and it's very much priced in at this point. Otherwise, Fed's Fisher, second in command, so to speak, at the FOMC, giving a speech. Not sure on the exact topic. I'll find out ahead of that time, but that's at 2 o'clock, so just ahead of the open on Wall Street. And obviously that will be interesting. Likelihood he'll be questioned about this outcome of the election midweek. Okay, gonna leave it at that, guys. So enjoy your session, and if I don't speak to you before then, in the remote, guys, have a good weekend.